Welcome back to our exploration of the market matrix. In our previous videos, we've examined how the market functions as a game within a game, how psychology drives price action, and how technical patterns reveal mass emotional behavior. Today, we're focusing on what might be the most important psychological battle of all, the one within your own mind. Risk management is typically presented as a mechanical process, position sizing, stop losses, and portfolio allocation. But beneath these mechanics lies a deeper reality. Risk management is fundamentally psychological. It's about managing your own emotions and cognitive biases in a system designed to trigger them. The truth is, even the best trading strategy will fail without proper risk management, and proper risk management will fail without understanding the psychology behind it. Let's start with the most fundamental concept, the risk-reward ratio. On the surface, this seems purely mathematical, risking $1 to potentially make $3, for example. But why do so many traders violate their own risk-reward parameters? The answer lies in our psychological makeup. Humans have evolved with cognitive biases that worked well for survival on the savannah, but work against us in markets. Loss aversion, our tendency to feel losses more intensely than equivalent gains, makes us close winning trades too early and let losing trades run too long. This directly undermines our intended risk-reward ratios. Then there's the disposition effect, our tendency to seek pride from realizing gains and avoid the regret from realizing losses. This explains why many traders quickly sell winners but hold on to losers, hoping they'll come back. Understanding these biases doesn't immediately eliminate them, but awareness is the first step toward developing psychological controls against them. Position sizing is another area where psychology trumps mechanics. The standard advice is to risk only a small percentage of your capital per trade, typically 1 to 2%. But the psychological reasons behind this rule are rarely discussed. When position sizes are too large, emotions overwhelm rational decision-making. A large position triggers heightened emotional responses, fear, greed, and anxiety. These emotions cloud judgment and lead to poor execution, moving stops, taking profits too early, or averaging down on losing positions. I've observed this in my own trading journey. When my position sizes grew too large, I found myself checking prices constantly, emotionally reacting to every tick, and second-guessing my analysis. By reducing position size to a level where I felt minimal emotional attachment, my execution improved dramatically. Position sizing isn't just about mathematical risk. It's about finding the sweet spot where you can remain psychologically detached from the outcome of any single trade. Now let's talk about stop losses, perhaps the most psychologically challenging aspect of risk management. A stop loss is a predetermined point where you exit a losing trade. Simple in theory, extraordinarily difficult in practice. Why? Because taking a loss requires admitting we were wrong. It requires overcoming the hope that the market will come back. It requires accepting the pain now rather than postponing it. The market plays on this psychological weakness. Have you ever noticed how often prices seem to hit your stop loss and then reverse in your original direction? This isn't just bad luck. It's market structure exploiting common psychological tendencies in stop placement. Developing a healthy relationship with stops requires a fundamental mindset shift. A triggered stop loss isn't a failure. It's the successful execution of your risk management plan. It's the cost of doing business in a probabilistic environment. Portfolio correlation is another aspect where psychological understanding matters. Diversification isn't just about mathematical risk reduction. It's about creating a portfolio that allows you to remain psychologically stable during various market conditions. When uncorrelated assets are properly balanced, the portfolio doesn't trigger overwhelming emotional responses during market extremes. This psychological stability enables better decision-making precisely when it matters most. Another critical psychological aspect of risk management is the concept of risk of ruin. This measures the probability of losing your entire trading capital. Mathematically, it's influenced by your win rate, risk-reward ratio, and position sizing. Psychologically, it's about understanding the compounding effect of emotional decisions under pressure. As account values decline, emotional pressure increases. This pressure leads to poor decisions, increasing position sizes to get back to even, abandoning tested strategies, or taking trades outside your system. These emotionally driven actions increase the risk of ruin beyond what mathematics would predict. The solution? Building in psychological circuit breakers. These might include taking a mandatory break after a series of losses, reducing position size after drawdowns, having preset points to reevaluate your strategy, maintaining a trading journal focused on emotional states. Speaking of trading journals, they're usually presented as tools for strategy refinement, but their greatest value may be psychological, creating self-awareness about how your emotional states influence your trading decisions. A proper trading journal tracks not just trades, but your psychological state before, during, and after each trade. Over time, patterns emerge. Perhaps you overtrade when bored, cut winners short when anxious, or ignore stops when overconfident. This self-knowledge becomes a powerful risk management tool, allowing you to recognize emotional states that lead to poor decisions before they impact your trading. There's also a meta-psychological factor to consider: your relationship with money itself. Our beliefs about money, often formed in childhood, unconsciously influence our risk tolerance and decision-making. Someone who grew up with financial insecurity might struggle with taking appropriate risks or realizing profits. Someone who ties their self-worth to financial success might take excessive risks or be unable to accept losses. Understanding your money psychology is essential for developing risk management parameters that work for you as an individual. Now for some practical application. Here's how to build a psychologically sound risk management framework. First, start with honest self-assessment. What are your emotional triggers in trading? When do you deviate from your rules? Under what conditions do you make your worst decisions? This self-knowledge forms the foundation. Second, build rules that protect you from yourself. If you know you get overconfident after winning streaks, create a rule that prevents increasing position size after consecutive wins. If you struggle with cutting losses, use hard stop orders rather than mental stops. Third, align your risk parameters with your psychological comfort. There's no perfect position size or stop distance, only what allows you to execute with minimal emotional interference. Finding this personal balance is more important than following generic rules. Fourth, create space between market events and your reactions. The most emotional decisions are usually the worst. Simple practices like taking a walk before executing a trade, writing down the reasons for a decision, or discussing it with a trusted trading partner can create valuable psychological distance. Fifth, develop resilience through proper capitalization. Trading with too little capital creates psychological pressure that distorts decision-making. Start with more capital than you think you need, so you can weather the inevitable drawdowns without emotional distress. In this game within a game, mastering the psychology of risk management might be the ultimate edge. Technical analysis can identify opportunities. Fundamental analysis can value assets, but only psychological mastery can ensure consistent execution over time. Remember, the market is designed to trigger your emotional responses. It's structured to exploit your cognitive biases. Without a deep understanding of these psychological traps and robust systems to manage them, even the best strategy will eventually fail. In our next video, we'll explore the psychology of market cycles, how to recognize where we are in the fear-greed continuum and position yourself accordingly. Until then, remember that in trading, managing your mind is just as important as managing your money.